Dividend growth is a key ingredient of a stock's performance, and the real magic is when that passive income starts compounding. Friends and family, my name is Amos, and today we're going to be looking at 18 companies that are rewarding their investors simply by being handsome. Look at you. Look at that smile. Look at that receding hairline. And these companies in question, they are raising their dividends and giving their shareholders like you and I a pay raise by doing nothing at all except by holding on to them. And by the way, dividend growth is so much more important than you think. It signals confidence from the management team, strong cash flow, and a business that's reliable and predictable. After all, you cannot consistently grow the dividend if your sales and operations are volatile. Ba-da-ba-ba-ba, dividend compounders with cheese. Welcome to part 2, picking up where we left off. The next dividend compounder in question is Salesforce, ticker symbol CRM, and they raised their dividend payout by 5.8%, and their forward trading multiple is a 14.8. Their dividend yield is 0.9%, the payout ratio is 22.5%, so it's more than sustainable and healthy. And I would argue as a tier 2 software enterprise backbone business, I really like Salesforce. Now, I could be wrong, but I still think it's one of the better deals in the software sell-off. However, better than a tier 2 are the tier 1 software conglomerates such as Microsoft, Google, and Amazon. And by the way, to fill you in, if you don't know what I'm talking about when I say tier 1 or tier 2, make sure you go and follow up on my tier ranking system, a video that I uploaded that breaks down the entire software landscape from tier 1 all the way to tier 4. And there we have it, friends and family. It took 7 companies for me to say cheese. This is a business operation that I would happily own at the right price. Now, the next company in question is going to be General Dynamics, ticker symbol GD, and they just grew their dividend payout by 6%. The current yield is 1.7%, and they've been growing their dividend for the past 35 years, or for as long as I've been alive on planet Earth. And when you think about it, the current administration, they're trying to increase the defense budget to $1.5 trillion. That's more than we have ever spent before. And when you take into account all the conflicts happening around the world, I cannot see General Dynamics underperforming the market, at least for the next 2.5 years. Now, I like General Dynamics. However, when you think about all of the equipment that's being used and will need to be replaced at a moment's notice because it's so essential to what's happening, my number 1 defense stock right now would have to be Lockheed Martin, hands down. Number 2 probably would be Northrop Grumman, and then number 3 would be General Dynamics. I could be wrong, but that's just how my brain is thinking. And the next dividend compounder is going to be Travel and Leisure Company, ticker symbol TNL, and they increased their dividend payout by 7.1%. The current dividend yield is 3.5%, and the payout ratio is 66%. However, there's a catch. So if we scroll down to take a look at their dividend payout visually depicted, this is a company that without hesitation, when the times get hard, whenever there's a speed bump, whenever there's a headwind, they cut the dividend. They do it again and again. So who is to say when there's an economic downturn, they will not cut their dividend? I think 100% they will cut their dividend. So as a result, that really influences my opinion on the company. Now, to take a step back, what exactly is Travel and Leisure? It's the vacation and timeshare business arm of the Wyndham brand. And essentially, you buy and accrue points to utilize for one of their vacation packages or one of their resorts. It's a pretty simple business model on paper. So when it comes to them, I think it's too cyclical for my taste buds. It's not my cup of tea, especially with their dividend history. I don't care what your dividend yield is if your history cannot back it up. So unfortunately, I am going to have to adjust my rating for them. This is not a company that I would bother entertaining to have a part of my family. So I would say, no way, Jose. And the next potential dividend compounder is going to be Ross Stores, ticker symbol ROST. They raised their dividend effectively by 10%. Dividend yield is 0.8%. And the payout ratio is 25%. So it's sustainable, and it seems to be pretty healthy for a retail chain. Now, to take a step back, if you don't know what Ross Stores is because you're from Austria or from Singapore, Ross Stores is essentially an off-price retailer that sells high-quality items like Calvin Klein, Hollister, Adidas for a discount. So what they do is they buy in bulk the past season stuff, such as from like 2022 summer, because as Adidas, you can't really sell that stuff anymore, right? And you have to make way in your warehouse for the new shipment of stuff, such as the 2026 summer apparel. So what do? You don't just throw it away. You're going to sell it by the pallet at a fraction of the cost, like 10% of the profits, right? And companies like Ross will buy it up and they'll put it out into their stores and sell it for a shirt that usually sold at retail for $100. They'll sell it for $40 and still make some profits from it. And they've ingrained a treasure hunting experience for the shoppers that make them repeat customers, because it's kind of similar to going thrifting. Because when you go to a thrift store such as Goodwill, you never know what's going to be there because the merchandise is always replenished. And I believe for Ross, the refresh rate is every 3 to 4 days. Whatever's on the shelves, it'll be gone in the next 72 hours. And I know this because I did a deep dive video for Ross and I uploaded it onto the channel. Between you and me, I think it's an interesting business model, but if you're bullish about the treasure hunting experience and shoppers being addicted to that methodology, especially a mom that's raising like 3 kids and she just brings them with her to go shopping at a Ross, I would rather go with Meta and Facebook Marketplace, because she could do the exact same thing without having to lug around 3 car seats and 3 strollers. She could do it from the comforts of her own home on the couch. The next potential dividend compounder is going to be Thermo Fisher Scientific, ticker symbol TMO. They raised their dividend payout by 10.3%. I just want to take a quick pause to say, at the end of the year, when you're talking with your supervisor, your manager, your boss, whoever is in charge of dictating what your next pay raise is going to be, for most of us, we're lucky to see a 3% raise for our compensation, let alone 5%. Friends and family, Thermo Fisher Scientific, they raised their dividend payout, once again, I'm going to say it, 10.3%. That is absolutely juicy. Now, what's not so juicy and cheesy is their dividend yield. It is 0.36%, so it's not even 1%. However, the payout ratio is 9.9%. I think out of the list so far of the 11 businesses, that's the lowest payout ratio that we have. But if you bought into Thermo Fisher Scientific in like 2010 or, 1999, then your yield on costs would probably make your dividend yield much higher than what it is right now. So what exactly is Thermo Fisher Scientific? Alongside with Danaher, they also just raised their dividend payout, but they didn't make this video. Maybe I should have made room for them, but both of them, they make all sorts of equipment and supplies for the biotech, science, and pharmaceutical space. However, right now, they're facing a ton of headwinds because they're losing funding from government-sponsored budget cuts. About a $300 million hit. So, as much as I like the company, my rating for them is cheese. The next 2.5 years, it should be painful for them. I don't think they're going to have good margins and good growth because the funding for them has been slashed, if that makes sense. So I guess in another optics, another perspective, maybe it's the time to load up on them while they're quote unquote undervalued. right? I can't say it with confidence because I haven't done a deep dive on them yet. I don't know if they're fairly valued or overvalued, but I do think it's a dividend compounder with cheese. I like them. At the right price, I would happily buy them so that they could be a part of my portfolio, paying me rent every 3 months. I like the sound of that, don't you? And the next potential dividend compounder is going to be Equifax, ticker symbol EFX. They just raised their dividend payout by 12%. Current dividend yield is about 1%. Payout ratio is 38%, and it says that their growth years is only 1 year. Scroll down and take a look at what's happening. So from 2017 to 2025, they essentially paid 39 cents every quarter, but at the end of in the middle of 2025, heading into 2026, they have decided as a business to start raising their dividend payout. So it is a little dodgy that they just kept their dividend consistent for so many years, but hey, now they're making the move to raise it, right? And the payout ratio is 38%. So I think it makes a lot of sense. And Equifax, they're one of the big consumer credit score companies alongside, if my memory serves me right, TransUnion, Fair Isaac, otherwise known as FICO, and Experian. And for that sector to be booming, it's contingent upon mortgage originations, people buying houses, and employment levels, because they do a credit check before you get hired, right? When I think about that, I would rather go with a more diversified business model in the credit rating giant S&P Global, because they make money from their S&P 500 index, and every index fund out there that uses their name, such as the NEOS SPY-E, they pay a cut to S&P Global to do that. They also make money from commodity pricing, market analytics, and credit ratings. So for me, I just feel like S&P 500, their economic moat is a little more durable and robust in comparison to Equifax. However, given the right price, like if their valuation makes no sense and their stock price happens to be at like a 5-year low, like right now, their forward trading multiple is a 21.6. But if that were to drop down to something that's unreasonable, like a PE ratio of an 8 or a 7, for me, I would buy into it, knowing full well what I just said about S&P Global, because at that valuation, it is worth the risk for me. And that's why I have it labeled as a maybe. Now, the next potential dividend compounder, I can't even say that. I think this next company, it's the definition of a yield trap, and that's going to be Shoe Carnival, ticker symbol SCVL. They increased their dividend payout by 13.3%. Current dividend yield is 3.47%. Payout ratio 28.5%. On paper, surface level, it looks really good. So why am I saying that they're a value trap? Because you buy into them for the high yield. However, your portfolio's valuation, the NAV erosion, it would be pretty bad. Because if we zoom out the past 5 years, negative 39%. So if you had $100,000 invested into them, can you imagine it getting reduced to $61,000 and I believe around $70? Can you imagine that, right? So what good is it to get a high dividend payout when your initial investment into them, your capital, erodes? And so for me, I have it labeled as a no way, Jose. Now, as a kid that grew up in poverty, we used to get our shoes from Payless and Shoe Carnival, okay? It's a budget footwear retail chain inside of shopping malls. So it's a company that I am familiar with, and I have sentimental feelings towards them for doing what they do, for selling shoes that are affordable. And I can see it being popular for families with young children so they can try on the shoes before buying. But unfortunately, as a business, I just don't see a growth catalyst for them, nor do they have an economic moat. There's no cheese, no competitive advantage, so no consideration from me. Again, this might be unpopular, but if we are going to be talking about affordable budget footwear, I would rather go with Walmart or Amazon. Except in the case of Amazon, you can't really try it on unless you buy it and return it. So I guess you technically could. Yeah, I think Walmart here would make more sense, and to a lesser degree, Target. And that's why, friends and family, investing into individual stocks, it's a little more complicated than we think. You can't just look at one metric such as the PE ratio, or in this case, the dividend growth rate. You also have to take into account what is the investing thesis. What are the risks? What's the bull case, the bear case? What are their fundamentals? What's their free cash flow yield? What's their PEG ratio? There's so much you need to take into account. And that's why, for simplicity's sakes, again, I'll say it, most of us were better off with SEHD and calling it a day. But for the few, the ones that are irrational like me, we like to invest into individual stocks because of the potential of outperforming or personalizing dividend payers that fit our exact needs. So I'm going to continue to do individual stocks. Moving on to the next potential dividend compounder, that's going to be Domino's Pizza, ticker symbol DPZ, and they just raised their dividend payout by 14.4%. My goodness gracious. Current dividend yield is 1.7%, and the payout ratio is 41%. So it's sustainable, and the growth rate is absolutely ridiculous. And I think in a crowded pizza market, I would argue Domino's Pizza is best in class, especially when you compare them to Papa John's, especially when you compare them to Pizza Hut. As a matter of fact, tuning into Yum Brands, Pizza Hut, they're not doing too well. What's helping them out a lot is Taco Bell, and then in second place, KFC. Their pizza arm of the business is kind of struggling, but Domino's, on the other hand, they're crushing and they're thriving. And their cheese, their economic moat of scale and supply chain, I think that's magnificent. It helps them to keep their costs in order. And the best part about Domino's Pizza is that they're innovative. They're not afraid of taking risks as they keep testing out new digital features for customers and even using robots to deliver pizza in Houston, Texas. I think when it comes to Domino's, guys, I really like this one. And so my personal rating for them is going to be cheese with an exclamation point. I really like Domino's Pizza. Probably not at their current valuation, but if they fall a little further, I might have to give them a look, a fair take. And the next potential dividend compounder is going to be Waste Management, ticker symbol WM, and they increased their dividend payout, very similar to Domino's Pizza, but a little better at 14.5%. The current dividend yield is 1.6%, payout ratio 51%. The amount of years they've been growing their dividend is 22. And here's the thing, guys. My rating for them is cheese. Reason being is making trash disappear. It's a business that will print cash in 2026. And when our grandchildren order Domino's Pizza when they're in their 40s and they just came home from work on a Friday night after their boss stressed them out and their hairline receded about 1.5 inches back. Making trash go away, that's a convenience we will continue to pay day after day, week after week, quarter after quarter. However, when it comes to waste management, I do want to say, much like Colgate-Palmolive, they're my third favorite garbage company, behind Waste Connections as my number one. Number two would be Republic Services. Waste Management being third, it doesn't mean that they're bad, just like Colgate-Palmolive. At the right price, I would love to own them. And between you and me, all else being equal, presented the opportunity of Colgate-Palmolive or Waste Management, like if I bought a scratch-off lottery ticket and I got 5 shares of my choosing, 100% I would go with Waste Management, okay? It's a compounder with cheese, no doubt in my mind. And the next potential dividend compounder is going to be Applied Materials, ticker symbol AMAT or AMAT, and they increased their dividend payout by a whopping 15.2%. Dividend yield is 0.5%. Payout ratio is 19.5%. Everything that I've said so far, is a screaming green flag as a dividend growth investor. I really like this company, and the reason being is that Applied Materials, they're the picks and shovels for the semiconductor battle. It doesn't matter if NVIDIA, AMD, Marvell, or Broadcom take turns being number one and the other ones go on a sell-off, because Applied Materials, they're still going to make money as long as the AI data center boom continues. I would say out of the semiconductor equipment manufacturers that sell it to TSM, to Intel, and to Samsung Foundry, my number one would be Lam Research. My number two would be Applied Materials. And again, number three would be ASML, but it doesn't mean that they're bad. That would just be the priority of order. If all three of them were to go on a sell-off, which one would I prioritize? It's just simple as that. And the next potential dividend compounder is going to be American Express, ticker symbol AXP. And if we take a look at their dividend profile, what are we working with? And American Express just grew their dividend by 15.8%, dividend yield 1%, payout ratio 22%. And my personal rating for them is a cheese. No doubt in my mind. I know there's folks out here that want to debate between Visa and MasterCard, who's the better option, thinking they're undervalued. Honestly, I'm not considering either one. I think the better choice and option is American Express. Their target demographic, having an above average median household income, means in a K-shaped economy where the top 20% is responsible for 80% of the spending in the economy, American Express and their affluent customer base, they're going to be thriving. I like them a lot, but not at their current valuations. I just looked into them, and I think there's still some more room to fall before I want to pick up shares and open up a position into them. When I used to be a corporate monkey, I used to travel a lot, and the Centurion Lounge for the American Express card holders, hands down, it is worth the annual fee. I'm telling you right now, sometimes the queue to get in, it was as high as like 30 minutes, maybe like 40 minutes, depending on the airport. But when you go in there, my goodness, it's a buffet and unlimited beverages, and you just get to relax before getting on a flight, sitting next to someone who's taking up all the elbow space on the armrest, smells like BO, person to your left is coughing nonstop, and it's a mess. For the 30 minutes that you're chilling in the Centurion Lounge, you can forget about all of that in anticipation of what's to come. So I really like American Express. I would love to buy them. And the next potential dividend compounder is going to be JD.com, ticker symbol JD, and they just grew their dividend by 31.6%. Absolutely outrageous. And the dividend yield is 3.5%. Payout ratio is 53%. But what I am not a fan of is the fact that their dividend payout schedule is once a year in the springtime. So it's not every month, it's not every quarter, it's once a year. So when you talk about reinvesting and compounding, it'll happen at a slightly slower rate, and I'm not a fan of that. All else being equal, I prefer a monthly frequency and then every 3 months. And as a last resort, twice a year, every 6 months like Disney is okay. But once a year, I'm not a fan of that. So what exactly is JD.com? They're essentially a part of the Chinese Mag 7. The American equivalent would be Amazon. JD.com, they built one of China's most advanced fulfillment and logistics infrastructures, from my understanding of the Chinese business landscape. JD.com handles everything in the e-commerce shopping experience from point A all the way to point Z when they deliver the package to the customer's doorsteps. However, all else being equal, I say it again and again on this channel, I'm bullish on the American economy. I'm bullish on the American stock market. So I would rather own Amazon, because the political and regulatory uncertainty tied to the CCP and their influence, it just makes Chinese companies just that much more challenging for me to evaluate and assess. That makes sense. If I had to invest into an international version of Amazon, I would look south and I would go with Mercado Libre, right? 1 out of every $3 spent online in Latin America is going to go through Mercado Libre. That makes me bullish. And then number 3, I would go with Coupang, which is the Amazon of South Korea. So I would consider all of those before I even think about JD.com. So what do you think of these potential compounders? I mean, we talked about 18 stocks. It's quite a lot. Which ones do you already own? Which ones do you despise? Which ones, after this video, are you going to do more research on? As for me, I think I'll add Thermo Fisher Scientific to my watch list, and I'll have to revisit my investing thesis for Domino's Pizza and Applied Materials to see what a good price to buy would be. And if you haven't already, please make sure to like and subscribe to support the channel. And if you want more content like this, please check out the Patreon. As always, I love y'all. Stay safe, good luck in the stock market, and I'll talk to you next time. Stay cheesy.